Preparing for a finance manager at NRG Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a finance manager at NRG Energy? NRG appeals to me because it combines complex energy markets with a customer-oriented business. I would bring strong planning, forecasting, and business partnering skills to help leaders understand earnings drivers, manage volatility, and allocate capital effectively. The role also fits my interest in translating operational data into decisions rather than simply reporting historical results. I am especially motivated by environments where finance improves accountability, strengthens controls, and supports profitable growth across generation and retail platforms. While answering, connect your finance leadership experience to NRG's competitive power, retail electricity, generation, customer focus, transformation agenda, and need for disciplined forecasting, performance management, and cross-functional decision support. Question 2. Walk me through your experience as a finance manager. In my current role, I lead monthly reporting, annual planning, rolling forecasts, and performance reviews for a multi-business portfolio. I manage analysts, review assumptions, and partner with operations, accounting, and commercial teams to explain variances and recommend actions. One improvement: I delivered standardized driver-based forecasting and reduced the reporting cycle by 2 days. I also strengthened review controls around manual adjustments. My management style is clear, developmental, and focused on producing decision-useful analysis. Make sure to cover team leadership, budgeting, forecasting, management reporting, variance analysis, controls, stakeholder influence, systems expertise, and one measurable example showing improved accuracy, efficiency, or business performance. Question 3. How would you forecast revenue for an energy business? I would build revenue from operational drivers rather than applying a simple growth rate. For retail, I would forecast customer counts, churn, usage, pricing, contract mix, and weather-sensitive demand. For generation, I would incorporate availability, dispatch, hedges, fuel costs, and forward power prices. I would create base, upside, and downside cases, then reconcile the model to billing and general ledger data. Monthly forecast reviews would isolate changes caused by volume, price, mix, timing, or assumptions. In your answer, discuss customer volumes, pricing, attrition, weather, load shape, contract mix, generation output, market prices, seasonality, regulatory factors, scenario analysis, and reconciliation to accounting and commercial data. Question 4. What are the most important financial KPIs for NRG Energy? The right KPIs depend on the business, but I would monitor adjusted EBITDA, free cash flow, liquidity, leverage, and return on invested capital at the enterprise level. Retail metrics would include customer growth, churn, usage, gross margin per customer, and acquisition cost. Generation metrics would include availability, dispatch, realized prices, fuel efficiency, and hedge performance. I would connect operational KPIs to financial outcomes so leaders can see both what changed and which actions can improve results. Be sure to mention revenue, adjusted EBITDA, free cash flow, customer counts, churn, gross margin, realized power prices, generation availability, hedging results, leverage, liquidity, and return on invested capital. Question 5. How do you perform a monthly variance analysis? I start by comparing actual results with budget, forecast, and prior year, then separate volume, price, mix, timing, and one-time effects. I prioritize material variances and investigate them with operational owners rather than relying only on ledger descriptions. After validating the root cause, I quantify whether the impact is recurring and update the forecast when appropriate. My final commentary explains the business driver, financial consequence, management action, and expected timing of resolution. Focus on establishing a reliable baseline, decomposing results into volume, price, mix, timing, and one-time items, validating with owners, identifying root causes, and converting findings into accountable corrective actions. Question 6. How would you manage forecasting during volatile power prices? In volatile markets, I would increase forecast frequency and use a driver-based model tied to forward curves, hedge positions, load, weather, fuel spreads, and plant availability. I would present sensitivities showing earnings and cash impacts from price, volume, and basis changes. It is important to distinguish realized results from mark-to-market movements and explain liquidity consequences separately. I would establish clear assumptions, ownership, and escalation thresholds so leadership receives timely, consistent information. Mention market data, hedge positions, weather, fuel spreads, scenario modeling, sensitivity analysis, liquidity implications, forecast frequency, governance, and clearly distinguishing realized performance from mark-to-market effects. Question 7. Explain the difference between generally accepted accounting principles earnings, adjusted EBITDA, and free cash flow. Generally accepted accounting principles earnings reflect recognized revenue, expenses, interest, taxes, and accounting adjustments under applicable standards. Adjusted EBITDA is a management measure intended to highlight operating performance by excluding items such as interest, taxes, depreciation, amortization, and defined special items. It must be reconciled transparently. Free cash flow focuses on cash generated after operating needs and capital expenditures. I would use EBITDA for operating comparisons, generally accepted accounting principles earnings for reporting, and free cash flow for liquidity and capital allocation. In your answer, distinguish accounting profit from non-generally accepted accounting principles operating performance and cash generation, discuss exclusions and reconciliation discipline, and explain why investors and management use each measure for different decisions. Question 8. How would you analyze a variance in gross margin for a retail electricity portfolio? I would bridge gross margin from budget to actual using customer counts, usage, price, product mix, procurement cost, hedge performance, and weather. I would separately assess balancing charges, transmission costs, bad debt, and acquisition-related effects because they can obscure the underlying customer economics. Then I would distinguish temporary market movements from structural pricing or churn issues. The output should show margin per customer, total contribution, root causes, and recommended changes to pricing, hedging, or retention. Make sure to cover customer volume, usage, pricing, procurement costs, hedging, weather, balancing charges, bad debt, product mix, acquisition costs, and bridge analysis from budget to actual margin. Question 9. What is your approach to budgeting and annual planning? I begin with strategic priorities and translate them into measurable financial and operational drivers. Business owners provide bottoms-up assumptions, while finance challenges volume, pricing, cost, headcount, capital, and timing expectations using historical performance and external benchmarks. I build scenarios where uncertainty is material, document assumptions, and resolve gaps through review meetings. Once approved, the budget becomes a management tool with monthly accountability, not a static file. Forecasts then reflect current facts while preserving the original plan for measurement. Discuss strategic alignment, driver-based assumptions, bottoms-up input, top-down targets, scenario planning, challenge sessions, ownership, approval governance, and converting the final budget into monthly performance accountability. Question 10. How would you evaluate a capital investment in a power generation asset? I would model operating cash flows using expected capacity, dispatch, power prices, fuel costs, operating expenses, taxes, maintenance capital, and asset life. I would calculate NPV and IRR using a risk-appropriate discount rate, while also reviewing payback and downside liquidity. Sensitivities should cover power and fuel spreads, availability, carbon or regulatory costs, construction overruns, and delayed commissioning. Finally, I would include strategic benefits such as reliability or portfolio diversification, while keeping those benefits transparent rather than embedding unsupported assumptions. Be sure to mention discounted cash flow, NPV, IRR, payback, capacity factors, power and fuel prices, operating costs, maintenance capital, regulatory risks, sensitivity cases, and strategic or reliability benefits. Question 11. How do you assess whether a forecast assumption is reasonable? I test an assumption against historical performance, current run rates, contracts, operating capacity, external market data, and independent benchmarks. I ask the owner what has changed and whether the assumption is achievable operationally, not merely desirable financially. For uncertain inputs, I quantify a reasonable range and show the earnings or cash sensitivity. I document the source, date, owner, and rationale, then revisit the assumption when new facts emerge. That process improves forecast credibility and accountability. Focus on historical evidence, external benchmarks, commercial contracts, operational capacity, market data, owner accountability, sensitivity analysis, and documenting assumptions so reviewers can challenge them consistently. Question 12. Describe a time you improved a finance process. Our monthly forecast process relied on multiple disconnected spreadsheets, creating version control problems and late submissions. I mapped the workflow, eliminated duplicate inputs, standardized driver definitions, and introduced a controlled template with automated checks. I partnered with business owners before implementation, trained the team, and monitored exceptions during the first 3 cycles. The process shortened preparation time by roughly 30%, reduced review comments, and created a clearer audit trail. I also documented ownership so the improvement would survive personnel changes. In your answer, explain the original problem, root cause, stakeholders, solution, controls, implementation approach, measurable result, and how you ensured the improvement remained sustainable after launch. Question 13. How do you manage and develop a finance team? I set clear priorities, define what good looks like, and match responsibilities to each person's strengths while creating stretch opportunities. I use regular one-on-ones to review work, remove obstacles, and provide specific coaching rather than waiting for formal evaluations. I encourage analysts to understand the business behind the numbers and present conclusions, not just schedules. I also build succession depth through cross-training and documented processes. A strong team should operate independently while knowing when to escalate. Mention clear expectations, prioritization, coaching, technical development, review cadence, delegation, psychological safety, succession planning, performance feedback, and adapting leadership to each employee's experience level. Question 14. How would you partner with accounting during the monthly close? I would agree on a close calendar, materiality thresholds, data ownership, and expected deliverables with accounting. Finance should help validate accruals, revenue completeness, operational volumes, and unusual items, while accounting retains responsibility for proper recording and technical compliance. I would review actuals promptly, reconcile reporting metrics to the ledger, and document approved adjustments. Clear communication prevents surprises, especially where estimates affect both close results and forecast assumptions. The objective is accurate reporting without weakening controls or independence. Cover close calendars, accruals, reconciliations, revenue completeness, intercompany items, management adjustments, materiality, variance review, controls, and maintaining a clean separation between reporting and forecasting responsibilities. Question 15. What internal controls are important in a finance manager role? Important controls include segregation of duties, appropriate system access, approval limits, account reconciliations, journal entry review, and documented support for estimates. For planning, I would control model versions, assumption changes, input ownership, and review sign-offs. I also expect periodic access reviews and timely investigation of exceptions. Controls should be practical and risk-based, not merely administrative. When a deficiency appears, I identify the root cause, assign an owner, set a deadline, and verify remediation through evidence. Be sure to discuss segregation of duties, access controls, approval limits, reconciliations, journal entry review, forecast governance, master data controls, documentation, evidence retention, and timely remediation of deficiencies. Question 16. How would you explain a complex financial issue to a non-finance executive? I would begin with the decision and headline impact. What happened, why it matters, and what I recommend. Then I would use a simple bridge or chart to explain the main drivers, clearly separating facts from estimates. For example, I might state that margin is below plan by $10 million, with $6 million from weather and $4 million from procurement costs. I would close with options, risks, timing, and the specific decision required. Detail can follow if requested. Focus on leading with the conclusion, using plain language, quantifying financial impact, separating facts from assumptions, explaining options and risks, and tailoring the level of detail to the executive's decision. Question 17. How do you prioritize competing requests from senior stakeholders? I rank requests by decision deadline, financial materiality, regulatory or control risk, strategic importance, and effort required. A board-related analysis or liquidity issue may take precedence over a lower-impact recurring request. I confirm the intended decision and minimum viable output before committing resources, then communicate trade-offs openly. If priorities change, I reset expectations rather than allowing all work to become urgent. Delegation and standardized templates help the team respond quickly without sacrificing analytical quality. Mention strategic importance, decision deadlines, financial materiality, regulatory or control risk, resource capacity, transparent trade-offs, communication, and renegotiating priorities when new urgent work appears. Question 18. How would you analyze liquidity for an energy company? I would build a rolling cash forecast covering operating inflows, customer collections, fuel and power purchases, collateral requirements, capital expenditures, debt service, and tax payments. Energy volatility makes stress testing essential, so I would model adverse price, volume, weather, and margin scenarios, including potential collateral calls. I would compare projected needs with cash, revolver capacity, and other committed sources. Reporting should highlight minimum liquidity, covenant headroom, timing risks, and management actions before a shortfall becomes urgent. In your answer, cover cash balances, operating cash flow, collateral and margin requirements, debt maturities, capital spending, working capital, hedging exposure, stress cases, committed facilities, and liquidity governance. Question 19. What is working capital risk in an energy or retail utility business? Working capital risk arises when cash timing differs materially from revenue or expense recognition. In retail energy, I would monitor receivables aging, collections, bad debt, customer deposits, supplier terms, settlement timing, and seasonal usage. In wholesale activity, collateral and margin requirements can create sudden cash needs even when earnings remain positive. I would use aging dashboards, collection actions, payment term analysis, and stress scenarios to protect liquidity. The goal is not simply reducing working capital, but managing it without damaging customer service or supply reliability. Discuss receivables, customer collections, payables, collateral, settlement timing, seasonal demand, bad debt, deposits, supplier terms, cash conversion, and balancing operational service with liquidity discipline. Question 20. Tell me about a time you challenged a business partner's assumptions. A commercial team proposed a volume forecast based on an aggressive customer acquisition plan. I reviewed historical conversion, churn, marketing capacity, and regional trends, then showed that the assumption required materially higher performance than our best prior period. Rather than rejecting it, I presented base and upside cases with the investment and staffing needed for the upside. Leadership adopted a more conservative forecast with trigger points for revision. The relationship improved because finance challenged the assumption while still supporting the growth objective. Be sure to show respectful challenge, evidence-based analysis, listening, alternative scenarios, relationship preservation, final decision quality, and how you handled the outcome when your recommendation was not fully adopted. Question 21. How do you ensure forecast accuracy without creating excessive process? I focus effort where forecast error has the greatest financial or decision impact. That means identifying the few critical drivers, automating data checks, using exception reporting, and applying deeper review to uncertain or material assumptions. I avoid forcing every line item into the same level of detail. After each cycle, I compare forecast to actual, categorize errors, and adjust the process or ownership. Accuracy improves when assumptions are transparent and timely, not when the model becomes unnecessarily complicated. Focus on materiality-based review, high-impact drivers, automated data validation, exception reporting, forecast calendars, accountability, postmortems, and avoiding unnecessary detail that does not improve decisions. Question 22. What would you do if actual results revealed a significant forecast error? First, I would quantify the error and communicate the impact promptly, avoiding defensiveness. Next, I would determine whether the cause was data quality, timing, model design, an incorrect judgment, or an unexpected external event. I would correct the forecast, update relevant scenarios, and document the explanation. If the issue was preventable, I would assign corrective actions such as better source data, review thresholds, or owner accountability. A forecast error is valuable when it improves the next decision rather than becoming a blame exercise. Mention rapid quantification, root cause analysis, communication, forecast correction, control assessment, ownership, scenario updates, and distinguishing an unavoidable external event from a preventable process or judgment failure. Question 23. How would you evaluate a potential acquisition or strategic investment? I would evaluate strategic fit first, then analyze quality of earnings, customer economics, market exposure, cash conversion, capital needs, and operational risks. The valuation model would include standalone cash flows, realistic synergies, integration costs, financing assumptions, and downside cases. I would test returns using NPV, IRR, and payback, while considering leverage and liquidity constraints. Due diligence should identify accounting or commercial issues before signing. After closing, I would establish synergy owners, milestones, and a transparent performance scorecard. Cover strategic fit, standalone performance, quality of earnings, synergies, customer economics, market exposure, valuation, financing, integration costs, downside cases, returns, and post-close performance measurement. Question 24. How do you use data and technology to improve finance reporting? I use technology to reduce manual work and improve consistency, beginning with reliable data definitions and ownership. I would connect ERP, operational, commercial, and planning data where appropriate, automate reconciliations and recurring reporting, and create dashboards focused on actionable KPIs. Strong governance remains essential. Access controls, validation rules, documentation, and periodic review of outputs. I also involve users early because adoption determines value. The goal is faster, more accurate analysis that gives managers time to investigate drivers and act. In your answer, discuss data governance, ERP and planning systems, automation, dashboard design, standardized definitions, reconciliation, access controls, user adoption, and ensuring technology produces actionable insight rather than more reports. Question 25. What would your priorities be in your first 90 days at NRG Energy? During the first 30 days, I would learn NRG's businesses, key performance drivers, reporting calendar, systems, controls, and stakeholder expectations. In the next 30, I would assess forecast assumptions, recurring pain points, team capabilities, and data quality, while validating priorities with business partners. By day 90, I would deliver a few practical improvements, such as clearer variance reporting or a streamlined forecast process, and propose a longer-term roadmap. I would prioritize credibility, listening, and measurable business impact. Be sure to mention listening, stakeholder mapping, understanding business drivers, reviewing forecasts and controls, learning systems, identifying quick wins, building trust, and agreeing measurable priorities with your manager. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.